Before we begin, please remember that the information provided in this video is for educational and informational purposes only. It is not intended to be, and should not be taken as legal, financial, or insurance advice. I am not a licensed insurance agent, broker, or financial advisor. The world of commercial insurance is complex and specific to your business's unique circumstances. Therefore, you should always consult with a qualified and licensed professional before making any decisions regarding your insurance coverage. Your reliance on any information in this presentation is solely at your own risk. Imagine this for a second. You did it. You quit your 9-to-5, you poured your life savings into your idea, and you launched your startup. The late nights, the endless pots of coffee, the constant stress. It's all starting to pay off. You're getting traction, customers are signing up. Revenue is trickling in. You feel that incredible, intoxicating rush of building something from nothing. Then one Tuesday morning, an email lands in your inbox. It's not from a customer. It's not from an investor. It's a formal notice from a law firm. Client is suing you. They claim your software had a critical bug that led to a massive data leak for their company. They're demanding a six-figure sum in damages. In that single moment, that one email, your entire world tilts on its axis. The dream you built with your bare hands is now hanging by a thread, threatened by a single lawsuit you never saw coming. This isn't some scare tactic from a Hollywood movie. This is the brutal reality for thousands of American startups every single year. In fact, a staggering 43% of small business owners have been threatened with or involved in a civil lawsuit. Let that sink in. Nearly half. The question isn't if a crisis will hit your business, but when. And the only thing standing between your thriving company and complete financial ruin is a piece of paper you probably haven't thought much about: your commercial insurance policy. But here's the problem. The insurance industry feels like it was designed by lawyers for lawyers. It's a maze of confusing jargon, hidden clauses, and intimidating paperwork. Premiums, deductibles, endorsements, exclusions, riders. It's a foreign language. And as a founder, you're already juggling a dozen other critical tasks. You don't have time to get a PhD in insurance law. So what do most of us do? We either put it off until it's too late, or we quickly buy the first policy someone sells us, crossing our fingers that it's the right one without any real confidence that it actually protects us. We treat it like a tax, a necessary evil, a box to be checked. And that is the single most dangerous mistake you can make. But what if I told you that you could flip the script? What if, instead of being a confusing, expensive chore, your insurance strategy could become one of your startup's most powerful secret weapons? A tool that not only protects you from disaster, but actually helps you grow faster, land bigger clients, and sleep soundly at night. That is exactly why I created this series. Over the next 10 parts, we are going to pull back the curtain on the commercial insurance industry. This is the Founder's Playbook. I'm going to give you a step-by-step guide to navigate this world with confidence, to find the exact coverage you need without overpaying for things you don't, and to turn your insurance from a liability on your balance sheet into a strategic asset. By the end of this, you will know more than 99% of other founders about how to properly protect your business. The first and most important step is a mental one. We have to completely reframe how we think about insurance. Stop thinking of it as just a shield. Start thinking of it as a key. It's a key that unlocks bigger and better opportunities. Do you want to sign a major contract with a Fortune 500 company? I can guarantee you, their legal team won't even look at your proposal until you can provide a certificate of insurance, or COI, proving you have, at a minimum, $1 million in general liability and often professional liability coverage. Do you want to lease a commercial office space? The landlord will demand to be listed as an additional insured on your liability policy. Want to hire your first W-2 employees? In almost every state, you are legally required to have workers' compensation insurance. See the pattern? The right insurance isn't just a defensive move. It's an offensive one. It's the ticket that gets you into the game. It signals to the world, to your clients, and to your partners that you are a serious, professional, and stable business. It builds trust. And in the world of startups, trust is everything. So, with that new mindset, where do we even begin? The insurance world can seem like an endless ocean of policies, but for most US-based startups, especially in the early stages, it all boils down to what I call the big three. These are the three foundational pillars of your entire risk management strategy. Get these right, and you've protected yourself against the most common company-killing disasters. First up is General Liability, or GL. This is the absolute baseline. Think of it as the slip and fall insurance. It protects your business against claims of bodily injury or property damage. Let's say a potential investor visits your home office, trips over your laptop cord, breaks their wrist, and decides to sue you for their medical bills. Your general liability policy is what kicks in to cover the legal fees and the settlement. Or let's say you're at a trade show, and a piece of your display falls and smashes someone's very expensive camera equipment. General liability covers that too. It's the fundamental, non-negotiable coverage for any business that interacts with the public in any physical capacity. The second pillar, and arguably the most important for tech and service-based startups, is professional liability insurance. You'll also hear this called errors and omissions, or E&O. This is your I messed up insurance. It protects you when your professional service, or your product, fails to perform as promised and causes a financial loss for your client, without causing bodily injury or property damage. That lawsuit we talked about at the beginning, the one where a software bug caused a data leak for your client, that's a classic professional liability claim. Or maybe you're a marketing consultant and a typo in an ad campaign you created costs your client thousands in lost sales. Or you're an architect and a flaw in your blueprint causes a costly construction delay. In all of these cases, it's not about a physical accident, it's about a professional or technical failure. If you sell expertise, advice, or software, E&O insurance is not optional. It is the core of your protection. And that brings us to the third pillar, which has become absolutely critical in our digital age: cyber liability insurance. This is your we got hacked insurance. General liability and professional liability often have specific exclusions for cyber-related incidents, which is why this standalone policy is so vital. A data breach is one of the fastest ways for a startup to go out of business. It's not just about the risk of a lawsuit. If your customer data is compromised, you could be on the hook for staggering costs. Forensic investigations to figure out what happened, credit monitoring services for all affected customers, public relations campaigns to manage your shattered reputation, and potentially massive regulatory fines for violating privacy laws like GDPR or CCPA. A cyber liability policy is designed to cover these exact first-party and third-party costs. In 2024, if your business touches any sensitive customer data, and whose doesn't? Going without cyber insurance is like driving a car without brakes. You're just waiting for a catastrophe. General liability for physical harm, professional liability for financial harm from your services, and cyber liability for digital harm. That's the foundational trifecta. Understanding the distinct role each one plays is the first step toward building an ironclad fortress around your dream. Now that you have this framework, we can move from the what to the how. How do you actually find a policy? How much should you be paying? And what are the hidden gotchas in the fine print that can render your policy useless when you need it most? We're going to break down all of it. In the next part, we're going to tackle the single biggest and most expensive mistake that founders make when they first go out to buy insurance. It's a subtle trap that brokers and online forums can lead you right into, and it can cost you tens of thousands of dollars in the long run. I'm going to show you exactly what it is and give you a simple framework to make sure you avoid it. You've laid the foundation. Now it's time to build the walls. The single biggest mistake a startup founder makes when buying insurance is treating it like a commodity. You treat it like you're buying a bag of rice at the grocery store. You see 3 different brands, they all look pretty much the same, so you grab the cheapest one and you move on. This is the trap. Because unlike rice, insurance policies are not created equal. Not even close. The difference between a $10,000 policy and an $11,000 policy isn't $1,000. The difference could be a $50,000 lawsuit that one policy covers and the other one doesn't. Let me tell you about a founder I know. We'll call him David. David built an incredible SaaS platform for managing logistics. He was brilliant, bootstrapped, and fiercely protective of every dollar in his company. When his first big enterprise client demanded he have a certificate of insurance, he did what most founders do. He went online, typed in business insurance, and found a site that promised a quote in 60 seconds. He answered a few basic questions, got a price that seemed reasonable, about $200 a month, and he bought it. He got his certificate, sent it to the client, closed the deal, and didn't think about it again. He checked the box. 6 months later, a bug in his software caused a massive shipping delay for that same enterprise client, costing them over $100,000 in penalties and lost goods. They, of course, sued David's startup to recover their losses. David wasn't worried. He thought, "This is exactly why I have insurance." He pulled up his policy, filed a claim, and a week later, he got a letter from his insurance company. Claim denied. Buried deep in the fine print of his bargain policy was an exclusion. A single sentence that said the policy does not cover financial losses caused by software failure. His $200 a month policy was effectively worthless for the biggest risk his software company actually faced. He was on the hook for the entire $100,000 loss plus legal fees. That cheap policy ended up costing him his company. David fell into the commodity trap. He focused on the price, not the value. He focused on checking a box, not managing his risk. This happens every single day. And the simple framework to avoid it is to completely flip the way you think about the process. You don't start by asking, how do I find the cheapest insurance? You start by asking, what are the biggest risks that could kill my company? This is the risk-first framework. It's a simple but profound shift. Instead of shopping for a product, you're creating a strategy. The very first step is to conduct your own internal risk audit. And don't worry, this isn't some complicated process that requires an army of consultants. You can do this right now with a pen and a piece of paper, or a blank document on your computer. We're going to break your startup's risks down into 3 core categories. First, liability risks. This is the big one. Simply means who could sue you and for what. Think about your business model. If you have a physical office or store, someone could slip and fall. That's a general liability risk. If you provide advice, develop software, or design products for clients like David, you could make a mistake that costs your client money. That's a professional liability risk, also known as errors and omissions. If you handle any customer data, names, emails, credit card info, and that data gets breached, you could face a massive lawsuit and regulatory fines. That's a cyber liability risk. Just start brainstorming. Think of the worst-case scenarios. What could a client, a vendor, a competitor, or a random member of the public accuse you of? Write it all down. The second category is property risks. What physical stuff do you need to operate your business that would be devastating to lose? This isn't just about your office building. It's the laptops for your team, the specialized manufacturing equipment in your workshop, the servers that run your platform, the inventory sitting in a warehouse. What would happen if there was a fire, a flood, or a major theft? Could you afford to replace everything out of pocket tomorrow and keep your business running? If the answer is no, that's a significant property risk. Don't forget about business interruption. If a fire shuts you down for 3 months, you still have to pay salaries, rent, and other fixed costs, all with zero revenue coming in. That interruption itself is a massive risk to your property and cash flow. And the third category is people risks. Your team is your greatest asset, but they also introduce unique risks. What happens if your key engineer gets into a serious car accident and can't work for 6 months? What if an employee is injured on the job? That's a workers' compensation risk, and in most states, having that insurance is a legal requirement the moment you hire your first employee. What if a disgruntled manager is accused of discrimination or wrongful termination? That's an employment practices liability risk, and those lawsuits can be incredibly expensive and emotionally draining, even if the claims are baseless. So you have these 3 buckets: liability, property, and people. Go through each one and list every potential risk you can imagine for your specific startup. An e-commerce store's risk profile is wildly different from a B2B SaaS company, which is different from a local construction firm. Be specific to you. Once you have your list, I want you to ask 3 simple questions for each risk you've written down. Question 1. What is the likelihood of this happening? Just use a simple scale: low, medium, or high. Question 2. What is the financial impact if it does happen? Again, keep it simple. Low meaning a few $1,000s. Medium, meaning tens of thousands, or high, meaning a 6- or 7-figure loss that could bankrupt the company. Question 3. Can my business survive that impact without help? A simple yes or no. Let's run David's case through this. Risk. Software bug causes client a major financial loss. Likelihood. For a new software platform, the likelihood of bugs is arguably medium to high. Financial impact. For an enterprise client, definitely high. Can the business survive it? For a bootstrap startup, a $100,000 hit is a clear no. Look at what this simple exercise does. It instantly pulls the most dangerous risks to the surface. You're no longer just looking for a piece of paper called a General Liability Policy. You're now looking for a specific solution to protect against a high-impact, high-likelihood risk that you know your business cannot survive on its own. You've moved from being a passive price shopper to an active risk manager. This list is your map. Without it, Calling an insurance broker is like asking a stranger for directions without knowing where you're going. You'll end up somewhere, but it's probably not where you need to be. But when you walk in with this risk audit, you change the entire conversation. You're not asking, "What do you have?" You're stating, "Here are my biggest threats. How do we build a shield to protect against them?" This is the foundation. This is how you avoid the commodity trap and start building the right walls for your business. You now have a clear, prioritized list of the dangers you face. You know which icebergs can actually sink your ship. But this creates a new critical question. How do you take this list of risks, your map, and translate it into the confusing, jargon-filled world of actual insurance policies? What is the difference between general liability and professional liability? What even is cyber insurance, and what does it actually cover? You have the diagnosis, but now you need to understand the prescription. Let's start with the absolute bedrock, the foundation of your business's protection: general liability insurance. Think of this as the slip and fall policy. It's the one that protects you from the most basic, physical, real-world accidents. A client walks into your office, trips over a power cord, and breaks their ankle. That's general liability. Your new intern is visiting a client's headquarters and spills a latte all over their $1,000 server. That's general liability. It covers bodily injury and property damage to third parties, meaning, not you or your employees, that happens on your premises or as a result of your business operations. It also covers things like advertising injury, like if your new marketing campaign accidentally uses a copyrighted image and you get sued. General liability is the Swiss Army knife of insurance. It's so fundamental that many commercial landlords won't even lease you an office space without proof you have it. It's non-negotiable. But here's where so many founders get confused. They think, "Great, I have general liability. I'm covered for any mistake I make." And that is a dangerously wrong assumption, because general liability covers you for causing physical harm, not financial harm. What happens if the mistake you make isn't a spilled coffee, but a line of bad code? What if it's a piece of faulty advice? That's where you step into the world of professional liability insurance, also known as errors and omissions, or E&O. Think of it this way: general liability is for when you drop the hammer on someone's foot. Professional liability is for when you, the architect, design a building that has a structural flaw. The mistake wasn't a physical accident. It was an error in your professional service, an omission in your duty, that caused your client a massive financial loss. If you're a consultant and you give advice that leads your client to lose $1 million, they're not going to sue you for a physical injury. They're going to sue you for professional negligence. If you're a software company and a bug in your code causes your client's entire e-commerce site to go down on Black Friday, costing them millions in sales, that's an E&O claim. Your general liability policy will be completely useless in that situation. It will not pay a single dime. For any startup that provides a service, offers advice, or creates a product that people rely on for their own business operations, which is basically every tech startup, professional liability is just as critical as general liability. It protects your brain, your expertise, and the very service you sell. Now let's talk about the one that keeps founders up at night. The modern-day boogeyman, the data breach. This is where cyber insurance comes in, and it is one of the most misunderstood policies on the planet. A lot of people think cyber insurance is just what pays the ransom if you get hit with a ransomware attack. And while it can cover that, that's like saying a firefighter's only job is to hold the hose. It's a tiny fraction of the picture. Imagine the nightmare scenario. You come into work on a Tuesday morning, and every screen in the office has a skull and crossbones on it, with a message demanding $200,000 in Bitcoin. Your customer database is gone. Your source code is encrypted. Your operations are dead in the water. This is a company-killing event. A good cyber insurance policy doesn't just cut a check for the ransom. It deploys a rapid response breach coach, usually a specialized lawyer, who becomes your quarterback through the entire crisis, often within hours. They help you determine if paying the ransom is even the right move. They bring in forensic IT experts to stop the bleeding, figure out how the hackers got in, and begin the painstaking process of rebuilding your systems and recovering your data. But that's just the beginning. In the United States, if customer data was compromised, you are legally obligated in almost every state to notify those affected. That means drafting notification letters, paying for postage for potentially thousands of customers, and setting up a call center to handle the flood of panicked, angry phone calls. Then, you'll likely have to pay for credit monitoring services for every single person affected, sometimes for years. All of this, the lawyers, the forensic experts, the notification costs, the call center, the credit monitoring, is astronomically expensive. We're talking costs that can easily dwarf the actual ransom amount. And all of it is what a robust cyber insurance policy is designed to cover. It's not just insurance. It's a full-blown disaster recovery service. Okay, so we've covered accidents, bad advice, and cyber attacks. What about your own team? If you have even one employee, and in many states that includes full-time, part-time, and sometimes even certain contractors, you are almost certainly required by law to have workers' compensation insurance. This one isn't optional. It's the law. If your graphic designer develops severe carpal tunnel syndrome from working on your company's laptop, workers' comp covers their medical bills and a portion of their lost wages while they recover. If a warehouse employee strains their back lifting a box of inventory, it covers their physical therapy. But here's the crucial part for you, the founder. Workers' comp is a grand bargain. In exchange for providing these benefits, the employee generally gives up their right to sue your company for that injury. It creates a no-fault system that protects your business from a potentially devastating lawsuit from an injured employee. Without it, you're not only breaking the law and facing hefty fines, but you're leaving your company wide open to litigation every single time an employee gets hurt on the job. Next up is the most straightforward policy of all, commercial property insurance. This one is simple. It insures your stuff, your physical assets, the laptops, the monitors, the office furniture, the inventory in your stockroom, even the physical office building itself if you own it. If a fire burns your office down, or a burst pipe floods your server room, or a burglar smashes a window and steals all your equipment, this is the policy that pays to replace everything. It's important to distinguish this from the property damage part of general liability. Remember, GL covers damage you cause to other people's property. Commercial property covers damage to your own property. Finally, let's talk about the insurance you need when you start playing in the big leagues, especially when you start taking other people's money. This is Directors and Officers Insurance, or D&O. This policy doesn't protect the company itself. It protects the personal assets of the company's leaders, the directors and officers. Imagine you raise $5 million from venture capitalists based on a set of aggressive financial projections. A year later, the market shifts, a competitor emerges, and you miss those targets by a mile. A group of angry investors could sue you and your board members personally, claiming you misrepresented the company's potential or mismanaged their investment. A lawsuit like that could target your personal bank accounts, your house, your car. D&O insurance steps in to pay for the legal defense of the directors and officers, and can cover settlements or judgments against them. It's a shield that protects your personal wealth from your corporate decisions. For this reason, most sophisticated investors won't join your board of directors, and many VCs won't even invest, unless you have a solid D&O policy in place. It's the cost of entry for serious fundraising. So there you have it. The 6 core pillars of commercial insurance. General liability for physical accidents, professional liability for financial mistakes, cyber for data disasters, workers' comp for employee injuries, property for your stuff, and D&O for your leadership. You now understand the different prescriptions available at the pharmacy. But which bottle do you actually need to take home? Do you need all of them? And what dosage is right for your specific condition? A solo freelance consultant versus a 20-person e-commerce company. Getting that combination wrong can be just as dangerous as having no medicine at all. So let's open that medicine cabinet. Staring back at you is a bewildering wall of bottles, all with long, complicated names. General liability, professional liability, cyber, workers' comp, D&O, EPLI. It's overwhelming. But just like with medicine, you don't start by trying to understand every single drug in the pharmacy. You start with the essentials, the foundational treatments that protect against the most common and dangerous ailments. For most US-based startups, this foundation is a holy trinity of coverage. Think of it as your business's Tylenol, Neosporin, and a high-grade antibiotic. You almost never leave home without them. Let's start with the absolute bedrock, the one policy that nearly every single business needs. From a solo graphic designer working from their kitchen table to a venture-backed SaaS company with a downtown office. This is General Liability Insurance, or GL. In our medicine cabinet, General Liability is the first aid kit. It's for the universal, non-specialized accidents. The slips, the trips, the falls, the oops, I broke your thing. It's designed to protect you from claims of bodily injury or property damage that you or your business caused to a third party. A third party is anyone who isn't you or your employee. A client, a vendor, a delivery person, the person you're meeting for coffee. Now, you might be thinking, I run a digital business. I don't have customers walking into a store. Why do I need slip and fall insurance? This is one of the biggest, most dangerous misconceptions for modern startups. The premises of your business follows you wherever you conduct business. Let's play this out. You're a consultant meeting a potential client at a coffee shop. You're so engrossed in your pitch that you gesture wildly, knocking your scalding hot latte all over their brand new MacBook Pro. They're not happy, and they send you a bill for $3,000 to replace it. That's a property damage claim. Your general liability policy is designed to handle that. Or imagine you've rented a booth at a trade show to demo your new software. Someone visiting your booth trips over a power cord you ran to your display, falls and breaks their wrist. They're out of work for 6 weeks, and now they're suing your startup for their medical bills and lost wages. That's a bodily injury claim. Without general liability, that lawsuit is coming directly out of your company's bank account, or worse, your personal one. It even covers things you might not expect, like advertising injury. Let's say in a marketing campaign you use an image you thought was royalty-free, but it wasn't. The photographer sues you for copyright infringement. Or a competitor claims your new ad slanders their product. General liability can step in to cover your legal defense for these kinds of claims. So, think of GL as your basic shield against the physical world and the common accidents of just existing as a business. Many commercial leases, client contracts, and partnership agreements will flat out require you to have it. It's non-negotiable. It's the bottle you grab for the everyday cuts and scrapes of doing business. But what about the work you actually do? What about the advice you give, the services you provide, the code you write? A first aid kit won't help you if you commit medical malpractice. For that, you need a specialist prescription. This brings us to the second foundational bottle in our cabinet, professional liability insurance, also known as errors and omissions, or E&O. If general liability is for claims of "you broke my laptop," professional liability is for claims of "your work broke my business." It protects you from claims of negligence, mistakes, or failure to deliver the professional service you were hired to provide. This is where the risk for startups skyrockets. You're a marketing agency, and you launch a major campaign for a client that, through a mistake in your analytics, targets the completely wrong demographic. The campaign is a massive flop, and the client claims your negligence cost them $500,000 in lost revenue. They sue. General liability won't touch this. This is a direct attack on the quality of your professional service. You need E&O. You're a software developer who builds a custom e-commerce platform for a retailer. A subtle bug in your code causes the checkout system to fail on Black Friday, the biggest sales day of the year. The client sues you for the catastrophic loss of business. That's an E&O claim. You're a business consultant who advises a company on a restructuring plan. The plan is implemented, but it leads to a massive drop in employee morale and productivity, costing the company dearly. They blame your faulty advice and sue you for negligence. Again, that's what E&O is for. The key distinction is this. General liability covers damages arising from your business operations. Professional liability covers damages arising from your business expertise. For any startup that provides a service, offers advice, or creates a product that others rely on to function, which is to say almost every startup, E&O is not a luxury. It's a core defense mechanism. It pays for your lawyer, court costs, and any settlements or judgments, up to your policy limit. Without it, a single angry client and a single alleged mistake can bankrupt you before you've even found product market fit. So we have our first aid kit for physical accidents, and our specialist prescription for professional mistakes. But we live in a digital world, where the most devastating threats are invisible. A virus can do more damage than a fire. A data breach can be more costly than a lawsuit over a broken wrist. This brings us to the third, and increasingly vital, bottle in our foundational trinity, cyber insurance. In our cabinet, this is the advanced vaccine and antidote all in one. It's designed to protect you from the unique and terrifying risks of the digital age. A decade ago, this was considered a niche policy for big tech companies. Today, it is as essential as the lock on your front door. If your business uses email, stores customer information, or operates a website, you are a target. Hackers don't just go after big banks anymore. Small businesses are often easier targets because their security is weaker. A cyber insurance policy is a two-sided shield. First, it covers your direct costs, what we call first-party costs. Imagine an employee clicks on a phishing link, and a ransomware attack encrypts all of your company's files. Your customer lists, your source code, your financial records. Everything gone. The hackers demand $100,000 in Bitcoin to unlock it. Cyber insurance can provide experts to negotiate with the hackers and can cover the cost of the ransom payment itself. It can pay for forensic investigators to figure out how the breach happened and what data was stolen. It can pay for the cost of restoring your data from backups and rebuilding your systems. These costs alone can be astronomical, but that's only half the story. The other side of the shield covers your liability to others or third-party costs. Let's say that ransomware attack didn't just lock your files. It stole the personal information of all 10,000 of your customers. Now you're in a world of hurt. State and federal laws require you to notify every single one of those customers. You'll likely have to pay for credit monitoring services for all of them for at least a year. You'll need a PR firm to manage the reputational damage. And then come the lawsuits. Your customers, angry that their data was compromised on your watch, can and will file class action lawsuits against your startup. Cyber insurance is designed to manage this entire nightmare scenario. It covers the notification costs, the credit monitoring, the PR, and most importantly, the legal defense and settlement costs from those lawsuits. For a startup, a data breach is an extinction-level event. Cyber insurance is the asteroid defense system. So there you have it. The foundational trinity. General liability, your shield against the physical world. Professional liability, your shield against claims about your work and expertise. And cyber insurance, your shield against the digital threats that can bring it all crashing down. Together, they form a comprehensive baseline of protection, addressing the most common ways a promising startup can get knocked off its feet. But is that it? Is this 3-bottle prescription all you need to be safe? Not by a long shot. We've just protected you from the outside world, from angry clients, accidental injuries, and anonymous hackers. What we haven't talked about are the threats that come from inside your own company. What happens when your co-founder is accused of misusing investor funds? Or when an employee sues you for wrongful termination? These are the internal diseases, the cancers and autoimmune disorders of a business, and they require a completely different set of powerful specialized medicines. And the most crucial of these specialized medicines is called directors and officers insurance. If general liability is the shield that protects you from the outside world, D&O is the armor that protects the company's brain and nervous system. Its leaders, from destroying itself from the inside out. Imagine this. You've done it. You've grinded for 2 years, living off ramen and pure adrenaline. You've built an incredible product, hired a small killer team, and just closed your $5 million series round. The lead investor, a sharp VC with a big reputation, is now on your board. The pressure is immense. You're supposed to hit a major product milestone in 6 months, but you hit a snag. A critical component from a supplier is delayed. The market shifts slightly. You miss the milestone. It's not a catastrophe, but it's a delay. Your investor, however, sees it differently. They see their money being mismanaged. They see a breach of fiduciary duty. The next thing you know, you, your co-founder, and your entire board are served with a lawsuit. The claim? Gross negligence in managing the company and misrepresenting the timeline to secure their investment. Your world just imploded. Forget building the product. Now you're spending your days talking to lawyers. The legal bills start piling up. $50,000, $100,000, $200,000 just for the initial defense. And this is money coming directly out of that precious series of funding. Money that was supposed to go to hiring engineers and marketers is now being funneled into a legal black hole. Even if you're completely innocent, the cost of proving it can bankrupt you. This is where D&O insurance steps in. It is, without exaggeration, the single most important policy for any startup that has taken outside capital or has a formal board of directors. D&O coverage is designed to pay for the legal defense costs, settlements, and judgments arising from these exact kinds of lawsuits. The ones that allege a wrongful act by a director or officer. Now, it gets a little technical here, but stick with me because understanding this is like knowing the difference between a Band-Aid and a tourniquet. D&O policies typically have 3 parts, known as Side A, Side B, and Side C. Side A is the personal life raft. It provides direct coverage for individual directors and officers when the company cannot legally or financially indemnify them. Let's say your company goes bankrupt during that lawsuit. It can't pay your legal bills. Side A kicks in and pays them for you, protecting your personal assets. Your house, your savings, your kids' college fund, they're shielded. Without Side A, a single corporate lawsuit could wipe you out personally. Side B is the company reimbursement. This is the most commonly used part of the policy. In our scenario, your startup is still solvent, and it's legally obligated to pay for your defense costs. You spend $200,000 on lawyers. Side B coverage then reimburses the company for that $200,000, minus your deductible. It refills the corporate bank account, allowing you to get that money back to work building the business instead of just surviving a lawsuit. Finally, Side C is the corporate shield. This provides coverage directly to the company itself when it's named as a co-defendant in a lawsuit alongside its directors and officers. This is particularly important for things like securities claims, where the lawsuit targets the corporate entity for its actions. So D&O is your ultimate defense against investor lawsuits, shareholder disputes, and claims of mismanagement. It's so critical that most venture capital firms will not release funding. They will not wire you the money until you have a D&O policy in place. It's not just a nice to have, it's the price of admission to the big leagues. It's also a powerful recruiting tool. You think a seasoned industry veteran is going to join your board of directors and put their personal net worth at risk without a D&O policy protecting them? Not a chance. But the threats don't just come from the boardroom or your investors. Sometimes the most financially devastating attack comes from within your own ranks. This brings us to the second critical internal medicine: Employment Practices Liability Insurance, or EPLI. Let's paint another picture. Your startup is growing, but you realize one of your early hires, someone you really liked personally, just isn't cutting it. They're consistently underperforming, and it's dragging the team down. After multiple warnings and a documented performance improvement plan, you have to make the tough call. You let them go. You do everything by the book, you think. 2 weeks later, a letter arrives from an attorney. The former employee is suing you for wrongful termination, claiming they were actually fired because of their age or their gender, or because they raised a safety concern a few months ago. The allegation is completely baseless. You know it, and you have the documentation to prove it. But here's the brutal reality. It doesn't matter. In the American legal system, the accusation alone is enough to start a war. A war that costs, on average, over $100,000 to defend, even if you win. Are you prepared to burn that kind of cash to prove you were right? Can your startup survive that kind of distraction and financial drain? EPLI is your shield in this war. It covers claims related to the entire employment lifecycle, from hiring to firing. This includes wrongful termination, discrimination, harassment, retaliation, and a host of other employee-related allegations. It pays for your legal defense, and if it comes to it, for a settlement or judgment. Think of EPLI as the HR department's bulletproof vest. In today's highly litigious environment, every single employee, from the intern to the C-suite, represents a potential lawsuit. A poorly worded joke, a perceived slight in a performance review, a promotion that someone felt they deserved but didn't get. Any of these can become the seed of a catastrophic EPLI claim. This insurance isn't about admitting you've done something wrong. It's about acknowledging the reality that you can be accused of doing something wrong at any time, and the cost of that accusation alone is a lethal threat to your business. Now, there's one more specialized treatment in this family of medicines, and it's one that founders often forget until it's too late. It's called fiduciary liability insurance. The moment you decide to offer your employees benefits, specifically a retirement plan like a 401k, you take on a new, very serious legal status. You become a fiduciary. In simple terms, this means you have a legal duty to act solely in the best interest of your employees when managing their benefit plans. It sounds simple, but it's a minefield regulated by a dense federal law called ERISA. Let's say you set up a 401k plan for your team. You pick a provider, you select a range of investment funds, and you get back to work. A year later, the market has been choppy, and the funds in your plan have slightly underperformed a different set of funds. Or maybe the administrative fees charged by your plan provider are a fraction of a percent higher than the absolute cheapest option on the market. Suddenly, you're hit with a class action lawsuit from your own employees. They allege that you, as the fiduciary, breached your duty by choosing suboptimal investment options or by failing to negotiate lower fees, costing them thousands in potential retirement savings. Again, it doesn't matter if you acted with the best intentions. The claim is that you mismanaged their money, and now you have to legally defend your decisions. This is what fiduciary liability insurance covers. It is not the same as EPLI. EPLI is about the act of employment, hiring, firing, harassment. Fiduciary liability is specifically about the management of employee benefit plans. It protects the company and its leaders from claims that they messed up the 401k, the health plan, or other employee benefits. So you have these three powerful, distinct shields. D&O to protect you from investors and shareholders, EPLI to protect you from employee lawsuits, and fiduciary liability to protect you from claims of mismanaging benefit plans. The good news is you don't usually have to buy them separately. They are almost always bundled together in what's called a management liability package. It's the startup survival toolkit, designed to protect the decision-makers from the complex, internal risks that come with running a company, managing people, and handling money. So you've done it. You've followed the playbook. You've built a fortress around your physical assets with general liability and property insurance. And now you've erected a sophisticated legal shield around your company's leadership and its most sensitive decisions with a management liability package. Your company is invincible, right? Wrong. Because the biggest Trojan horse isn't wheeled to your front gate anymore. It arrives as an email attachment. It's a Tuesday morning. One of your employees, let's call him Kevin, is clearing out his inbox. He sees an email from a vendor with an invoice attached. Looks legit. He clicks. For a split second, his screen flickers. He thinks nothing of it. But in that nanosecond, the digital DNA of your entire company was rewritten. The locks on every single one of your files were changed. Your customer database, your financial records, your intellectual property, your payroll, everything encrypted. Gone. Replaced by a single text file on every computer. A skull and crossbones, a countdown timer, and a demand for $200,000 in Bitcoin. This is not a hypothetical. This is the new reality of doing business. And this is where we introduce the fifth core pillar of your startup's insurance fortress, Cyber Liability Insurance. Now, a lot of founders hear cyber insurance and think it's just for big tech companies or banks. They think, we use cloud services, we have antivirus software, we're too small to be a target. That is dangerously, catastrophically wrong. Startups are the single most attractive target for cyber criminals. Why? Because you have what they want: customer data, payment information, proprietary code, but you often lack the Fort Knox-level security of a Fortune 500 company. You are the low-hanging fruit with the sweetest juice. So what does a cyber liability policy actually do when Kevin's click unleashes hell? It's not just a check. It's a digital SWAT team. The moment you report the incident, the policy activates. It deploys a team of experts who parachute into your crisis. First, you have the breach coaches. These are specialized attorneys who act as your quarterback. Their first job is to protect you under attorney-client privilege, so the investigation into how badly you messed up can't be used against you in court later. Next, the policy unleashes the IT forensics team. These are the digital detectives who storm the crime scene. They determine the scope of the breach. How did they get in? What did they take? Are they still in our system? This is a critical, expensive, and time-sensitive process that you absolutely cannot afford to handle on your own. While the forensics team is working, the policy is already addressing the fallout. This is where we split cyber coverage into two main buckets: first-party costs and third-party costs. Think of it as the money to fix your own mess, and the money to pay for everyone else's mess. Let's start with first-party costs, fixing your house. The most obvious one is business interruption. Every hour your systems are down, you are bleeding money. You can't process orders, you can't serve clients, you can't operate. A good cyber policy reimburses you for the income you lost during that downtime. It keeps your company breathing while it's on the operating table. Then there's the cost of data recovery. The forensics team might be able to restore your data from backups, but that takes time and money. If they can't, you might have to rebuild it from scratch, or worse, pay the ransom. And yes, most cyber policies include coverage for extortion and ransom payments. The insurer brings in professional negotiators who deal with these criminal gangs for a living. They can often negotiate the ransom down and will facilitate the complex, nerve-wracking process of paying in cryptocurrency to get the decryption key. They pay the ransom so you don't have to drain your bank account. But the costs don't stop there. Once you discover that customer information was compromised, the clock starts ticking on a legal time bomb. State and federal laws, like California's CCPA, require you to notify every single person affected. This isn't just sending an email. It involves drafting legally compliant notices, paying for postage for physical letters, and setting up a call center to handle the flood of panicked inquiries. For a database of 50,000 customers, this notification process alone can cost tens, even hundreds of thousands of dollars. Your cyber policy pays for this. To prevent the inevitable lawsuits, you'll also want to offer credit monitoring services to everyone affected. Your policy covers the cost of signing up all your customers for a service like LifeLock or Experian. It's a goodwill gesture that's also a powerful legal shield. So to recap the first-party costs: business interruption, data recovery, ransom payments, legal breach coaches, IT forensics, customer notification, and credit monitoring. That is a mountain of expense that would bankrupt most startups overnight. But we're only halfway done. Now we have to talk about third-party costs, the money for the messes you created for others. This is liability. This is when people start suing you. Your customers can sue you in a class action lawsuit for failing to protect their data. A business partner can sue you if the breach on your system spread to theirs, causing them to lose business. These lawsuits are existential threats. The legal defense costs alone, even if you're eventually found innocent, can be astronomical. Your cyber liability policy covers those defense costs and will pay for settlements or judgments against you, up to your policy limit. And then there are the regulators. If you handle health information, you have HIPAA. If you handle financial data, you have other federal watchdogs. If you have customers in Europe, you have GDPR. These agencies can and will levy massive fines for privacy violations. We're talking fines that can be a percentage of your global revenue. Your cyber liability policy is designed to cover these regulatory fines and penalties as well. So how do you, as a startup founder, get the right policy? First, understand that the application process itself is a free security consultation. The questions the insurance company asks are a roadmap to your own vulnerabilities. Do you have multi-factor authentication on all critical accounts? Do you have encrypted, segregated backups? Do you have a formal incident response plan? If you answer no to these questions, you'll either be denied coverage or charged a much higher premium. Use the application to identify and fix your own weaknesses before you're a victim. When you look at the policy itself, don't just look at the price tag. Look at the sublimits. A $1 million policy might sound great, but it might have a sublimit of only $50,000 for regulatory fines, which is next to useless. Check the exclusions. Does it cover social engineering, where an employee is tricked into wiring money to a fraudulent account? Does it cover bricking, where a cyber attack renders your physical hardware permanently useless? Choosing your limit is also crucial. It should be based on the number of sensitive records you hold. A simple rule of thumb is to calculate the potential cost per record, including notification, credit monitoring, and legal liability, and multiply that by the number of records you store. For a small B2B SaaS company, that might be a $1 million limit. For a direct-to-consumer app with hundreds of thousands of users and their payment info, you might need a $5 or $10 million policy from day one. The digital world is the new Wild West, and hackers are the new bandits. Going without cyber liability insurance is like building a bank and leaving the vault door wide open with a sign that says, "Free money." It's not a matter of if you will be targeted, but when. You've now put a digital shield around your company's most valuable asset. It's data. You've protected your leadership from lawsuits with a management liability package. You've covered your physical space and your people. You're feeling secure. But you've forgotten about the one thing that your entire business is built on. The thing you actually create and sell. You just shipped your first 10,000 units. And deep inside one of them is a tiny microscopic flaw. A flaw that's about to cause a $5 million problem. That microscopic flaw sits dormant for 3 weeks inside a sleek, minimalist smart kettle in a suburban kitchen in Ohio. Then one Tuesday morning, a faulty temperature sensor fails to shut off the heating element. The water boils away. The element overheats. The plastic housing, not rated for that temperature, begins to melt and then ignites. The fire is small, but it's fast. Catches the kitchen curtains. By the time the fire department arrives, the entire first floor of the house is a gut job of smoke, soot, and water damage. Thankfully, no one is hurt. But the homeowner's insurance company isn't so forgiving. Their investigators trace the origin of the fire directly back to your smart kettle. And 2 months later, a certified letter arrives at your small office. It's not a thank you note. It's a subrogation claim from a massive insurance carrier for $1.2 million in property damage. Your stomach turns to ice. But that's just the beginning. A week later, a second letter arrives. This one is from a law firm. They're launching a class action lawsuit on behalf of all 10,000 customers who bought your kettle, claiming the product is inherently unsafe and demanding a full recall and punitive damages. The number they're throwing around is $5 million. Welcome to the brutal, terrifying world of product liability. This is the specific type of risk that keeps founders of physical product companies awake at night. And it's covered by a specific policy. Product liability insurance. It's often bundled within a general liability policy, but you have to make sure it's there, and that the limits are high enough. Because this is the one that can sink you. Product liability claims generally fall into three terrifying categories. The first is what our fictional founder just experienced. A manufacturing defect. This is when your product is designed perfectly, but something goes wrong on the assembly line. A screw isn't tightened, a wire isn't soldered correctly, a chemical is mixed in the wrong proportion. 9,999 of your products are flawless, but one is a ticking time bomb. You did everything right in the design phase, but a mistake by a person or a machine somewhere in the supply chain has now put your entire company on the line. The second category is even worse. A design defect. This is where the mistake isn't a one-off. It's in the blueprint. The product is being manufactured exactly to your specifications, but the specifications themselves are flawed. The plastic you chose is too thin. The internal wiring is too close to a heat source. The center of gravity is too high, making it tip over easily. This is a nightmare scenario because it means every single unit you've ever sold is defective. It's not a single lawsuit you're facing. It's a potential lawsuit from every single customer. This is what triggers massive company-killing recalls. But the third category is the most insidious. It's the one most startups fail to see coming. It's called a marketing defect, or more commonly, a failure to warn. This is when your product is designed perfectly and manufactured perfectly, but you fail to provide adequate instructions or warnings about how to use it safely. You sell a powerful blender but don't include a warning to never put your hand inside while it's plugged in. You sell a children's toy with small parts but don't include a clear choking hazard warning for children under 3. You create a skincare product and don't warn users to test it on a small patch of skin first, and someone has a severe allergic reaction. The court doesn't just ask, is the product safe when used correctly? It asks, could you have reasonably foreseen a way for someone to misuse this product and hurt themselves, and did you adequately warn them against it? This is the real story behind the infamous McDonald's hot coffee case. Most people think it was a frivolous lawsuit about coffee being hot. The reality is the coffee wasn't just hot. It was heated to a temperature far above industry and home brewing standards, a temperature capable of causing third-degree burns in seconds. McDonald's own documents showed they had received over 700 previous reports of severe burns from their coffee and had done nothing. The jury wasn't punishing them because the coffee was hot. They were punishing them for a known design defect and a complete failure to warn customers of the serious danger. So now let's go back to our founder staring at that $5 million lawsuit. What happens next? Their first call is to a lawyer. The lawyer says they have a defensible case, but to even get started, they'll need a $50,000 retainer. Just to begin the fight. The legal bills to fight a multi-year class action lawsuit could easily climb into the hundreds of thousands, or even millions of dollars. And that's if they win. If they lose, they're on the hook for the full $5 million judgment plus legal fees. The startup has maybe $200,000 in the bank. They are, for all intents and purposes, finished. Game over. But let's rewind. What if 6 months earlier, that founder had worked with a broker and put the right insurance in place? What if they had a general liability policy with a $2 million product liability limit? Now the story changes completely. When that certified letter arrives, their stomach still turns to ice. But their first call isn't to a lawyer they can't afford. It's to their insurance broker. They file a claim, and the insurance company takes over. That $50,000 retainer? The insurance company pays it. They assign a top-tier law firm that specializes in product liability defense. All the mounting legal bills for depositions, expert witnesses, and court filings? The insurance company pays them. The insurance company's lawyers might decide to fight the case in court, or they might decide it's better to negotiate a settlement. If they settle for, say, $1.5 million, the insurance company pays it. If the case goes to trial and they lose a $2 million judgment, the insurance company pays that too. The founder, while still going through an incredibly stressful process, is shielded. The business survives. The insurance policy didn't just protect them from a $5 million loss. It gave them access to a multi-million-dollar legal defense they could have never afforded on their own. So the critical question is, how much coverage do you actually need? This isn't a one-size-fits-all answer. It depends entirely on your specific risk. First, what are you selling? There's a world of difference between selling throw pillows and selling electric skateboards. The more potential your product has to cause serious injury or property damage, the higher your limits need to be. Anything that gets ingested, put on the skin, plugs into a wall, or is designed for children is automatically in a higher risk category. Second, where are you selling it? If you're just selling a few items on your own website, you might start with a standard $1 million liability limit. But the moment you decide to scale, that changes. If you want to sell your product through Amazon's FBA program, they will require you to have a certificate of insurance proving you have, at minimum, $1 million in coverage. If you want to get your product on the shelves at Target, Walmart, or Home Depot, they will laugh you out of the room if you don't have $2 million, $3 million, or even $5 million in coverage. Why? Because they are not going to take on the risk of your product. They are forcing you to prove that if your product burns down a customer's house, it's your insurance company that will pay for it, not theirs. In this sense, product liability insurance isn't just a defensive shield. It's a key that unlocks access to major distribution channels. It's a non-negotiable cost of doing business at scale. Your coverage needs to be a living, breathing part of your business plan, reviewed every single year. As your sales volume grows from 100 units a month to 10,000, your total exposure to risk grows right along with it. Your policy limits need to reflect that growth. For the founder of that smart kettle company, a simple insurance policy would have been the difference between a catastrophic failure and a painful but survivable business lesson. It transforms a company-ending event into a manageable problem. That flawed kettle represents a physical threat, a tangible object that caused a tangible fire. But what happens when your product is intangible? What if you're not selling hardware but software? What if the flaw isn't a faulty wire, but a single line of bad code in your app? The damage isn't a burned-down kitchen, but the stolen data of 1 million users. The threat isn't a fire you can see, but a digital wildfire tearing through your servers, a catastrophe that can be just as devastating and requires a completely different kind of protection. This is the world of cyber liability insurance, and for a modern startup, it's not an option. It's as essential as having a lock on your office door. Because the average cost of a data breach for a small business in the United States is now well over $100,000. For most startups, that's not a setback. That's a death sentence. So what does this digital armor actually do? It's typically broken down into two crucial parts: first-party and third-party coverage. First-party coverage is for your direct losses. Imagine you run a small e-commerce business selling custom-designed sneakers. A hacker gets in, locks up your entire customer database, and demands a $50,000 ransom. Your first-party cyber coverage is what kicks in here. It can help cover the cost of hiring a cybersecurity firm to investigate the breach and restore your data. It can cover the cost of the ransom payment itself, if that's the advised course of action. It covers the business income you lose while your website is down and you can't make sales. And critically, it covers the cost of notifying all your customers that their data was compromised and providing them with credit monitoring services to protect them from identity theft. That last part isn't just good customer service. In most states, it's the law. Without insurance, the cost of notifying thousands of customers and paying for 2 years of credit monitoring can be astronomical on its own. But that's only half the story. The other side is third-party coverage. This protects you from the lawsuits that come after the breach. Because those customers whose data was stolen, they're not just going to be understanding, they're going to be angry. They trusted you with their personal information, and now they're at risk. They'll sue you for damages. State and federal regulators might also come knocking, hitting you with massive fines for failing to adequately protect consumer data. Third-party cyber liability coverage is what pays for your legal defense, the settlements, and the regulatory penalties. It's the shield that protects you from the fallout of the digital explosion. So, cyber insurance handles the external malicious attacks. But what happens when the damage isn't caused by a faceless hacker from across the globe, but from a mistake made right inside your own company? What happens when the error isn't a security flaw, but a professional one? This is where you need another specialized shield: errors and omissions insurance, also known as E&O or professional liability. If you provide a service or give advice for a fee, you need this. Period. It protects you and your business from claims of negligence, mistakes, or failure to deliver on a promised service. Let's be clear. This isn't about intentional fraud. This is about human error. Imagine you're a marketing consultant. You launch a major campaign for a new client, but you accidentally use a copyrighted image you didn't have the rights to. The owner of that image sues your client for infringement, and your client, in turn, sues you to cover their massive legal bills and settlement costs. That's an E&O claim. Or maybe you run a small software as a service company. You push out a new update, but it contains a hidden bug. That bug causes a critical system failure for one of your biggest clients, halting their operations for 2 days and costing them hundreds of thousands of dollars in lost revenue. They're coming after you for that loss. Your E&O policy is what stands between your company's bank account and their legal team. The most important thing to understand about errors and omissions insurance is that you don't actually have to have done anything wrong to be sued. A dissatisfied client can claim you were negligent, even if you did everything by the book. They can claim your advice was bad, even if they were the ones who implemented it incorrectly. In our lawsuit-heavy culture, the accusation alone is enough to trigger a legal battle. And even if you win the case and are proven completely innocent, you could still be on the hook for $50,000, $100,000, even $200,000 in legal defense fees. E&O insurance covers those defense costs from the very first day, protecting you from a lawsuit that could bankrupt you, regardless of the outcome. So, we've protected the business from digital attacks with cyber insurance, and we've protected it from our own professional mistakes with E&O. But what about the people in charge? The founders, the executives, the board of directors, the ones making the high-stakes decisions every single day. What protects them personally? This brings us to one of the most misunderstood but absolutely critical policies for any startup that plans to grow: Directors and Officers Insurance, or D&O. D&O insurance does not protect the company itself. It protects the personal assets of the directors and officers. Your house, your car, your savings, your kids' college fund. It protects them from lawsuits alleging a wrongful act committed in their capacity as leaders of the company. And who would sue the leaders of a startup? The list is longer than you think. Investors are a big one. Let's say you raise a round of funding based on a set of financial projections. If you fail to meet those projections, disgruntled investors could sue the board, claiming you misrepresented the company's potential. Employees can sue for things like wrongful termination or creating a hostile work environment. Customers can bring class action lawsuits. Competitors can sue for unfair business practices. The government can investigate and levy penalties. A D&O policy covers the legal defense costs for the individuals named in the lawsuit. It can pay for settlements and judgments against them. And here is the key takeaway. If you ever plan on taking investment money from venture capitalists or angel investors, or if you want to attract experienced, high-caliber individuals to sit on your board of directors, having a D&O policy is non-negotiable. No serious investor will put their money into a company where the leadership is personally exposed, and no experienced professional will join your board without it. It's a sign of good corporate governance. It shows you're serious. It's the ticket you need to even get into the big leagues. Closely related to D&O is Employment Practices Liability Insurance, or EPLI. Think of it as a specialized offshoot. While D&O covers broad management decisions, EPLI focuses specifically on the risks that come with having employees. The moment you hire your very first person, you are exposed to claims of discrimination, sexual harassment, wrongful termination, failure to promote, and a dozen other employment-related issues. EPLI is the policy that defends you against these claims, which are incredibly common and emotionally and financially draining. These policies, Cyber E&O, D&O, EPLI, are the invisible shields of the modern startup. They protect against threats that aren't physical, but are every bit as real and potentially devastating as a fire or a flood. They aren't just expenses on a balance sheet. They are strategic investments in your company's resilience, its reputation, and its ability to grow. They give you the confidence to innovate, the security to hire top talent, and the credibility to attract investment. We've now identified the key types of armor your startup needs to survive and thrive in a complex world. But knowing you need a sword and shield is one thing. Actually walking into the armory, understanding the difference between Damascus steel and cheap iron, and not getting ripped off by the blacksmith, that's a whole different battle. And that's exactly where we're headed next. So you're standing at the entrance to the armory. The air is thick with the smell of coal smoke and hot metal. All around you, so-called experts are hawking their wares. One is yelling about the lowest prices. Another is showing off a shiny but flimsy-looking shield. And you, the founder, need to choose the one person who will forge the armor that protects everything you've built. No pressure, right? This is the most critical decision you'll make in this entire process. Choosing the right insurance partner, your guide, your advisor, your blacksmith, is more important than choosing the insurance policy itself. Because a master craftsman will guide you to the right materials and build you a suit of armor that fits perfectly. A charlatan will sell you a generic, ill-fitting tin can that will crumple at the first blow, leaving you exposed when it matters most. So, how do we find this master craftsman? First, you need to understand the three types of blacksmiths in this market. First, you have the captive agent. Think of this as the royal blacksmith. They work for one and only one kingdom. Let's call it the Kingdom of Allstate, or the Empire of State Farm. They know their kingdom's armor inside and out. Every rivet, every plate, every secret forging technique. The benefit? Deep specialized knowledge of one set of products. The downside? If the royal armor isn't the right fit for you, they can't exactly run over to the neighboring kingdom and grab something better. Their loyalty is to the throne, not necessarily to you. They'll do their best to make their kingdom's armor work, but it's the only armor they can sell. Second, you have the independent broker. This is the guild artisan. They don't serve a single king. They have relationships with dozens of different kingdoms and forges. They can look at your specific needs, your size, your fighting style, the dragons you expect to face, and then go out to the entire market to find the best possible armor from the best forges. Their loyalty is to you, the client. They are your champion in the marketplace. This flexibility is their greatest strength. They can mix and match a helmet from one forge with a breastplate from another to create a truly custom solution. And third, you have the new age option, the direct-to-carrier or Insurtech platforms. This is the do-it-yourself forge. You go online, you answer a few questions, and an algorithm spits out a suit of armor for you. It's fast, can seem cheap, and for a very simple business like a solo warrior who just needs a basic leather tunic, it might be fine. But for a startup, a complex, growing entity with unique risks, this is like trying to forge your own Valyrian steel sword after watching a 5-minute YouTube tutorial. The chances of you missing a critical step, leaving a fatal gap in the armor, or choosing the wrong metal entirely are astronomically high. You save a little time and money up front, only to pay for it with your entire kingdom later. For 99% of US-based startups, the choice is clear. You need an independent broker. You need that guild artisan who works for you, who has access to the entire market, and who can be your long-term strategic partner. Okay, so we've decided we need an independent broker. Great, but there are tens of thousands of them. How do you find the one? The master craftsman? This is the hunt. And it starts not with a Google search but with your trusted counsel. Your first and best source is referrals. Talk to the people who are already in your corner. Your lawyer, your accountant, your investors or board members. These people work with hundreds of companies. They've seen which blacksmiths forge dependable armor and which ones deliver scrap metal. Ask them, who is the best insurance broker you've ever worked with for a company like mine? This is a golden question. Next, go to your tribe. Find other founders in your specific industry. If you run a SaaS company, talk to other SaaS founders. If you're in biotech, talk to biotech founders. Ask them who they use and, more importantly, why. Did their broker help them through a tough claim? Did they find a creative way to cover a weird, industry-specific risk? This is intel from the front lines. It's invaluable. Finally, you can turn to strategic online searching. But we're not just typing business insurance into the search bar. That's like shouting, "I need a sword," in the middle of a crowded city. You'll be swarmed by apprentices and snake oil salesmen. You need to be specific. Search for independent insurance broker for tech startups, or cyber insurance specialist for fintech companies, or product liability broker for CPG brands. The more niche you get, the more likely you are to find a true specialist. An expert who only builds armor for dragon slayers is going to be infinitely better than a generalist who also makes pots and pans. Now, you've assembled a list of 3 to 5 potential brokers. The hunt is over. The interrogation begins. You need to vet these candidates like you're hiring a C-suite executive because that's how important this role is. Here are the non-negotiable questions you must ask every single one. Question 1. What is your specialty, and how many clients do you have in my industry? This is the filter question. You want to hear them say, "We live and breathe tech startups. About 70% of our clients are high-growth SaaS and fintech companies, just like you." What you don't want to hear is, "Oh, we do a bit of everything. Restaurants, construction, tech, you name it." A generalist cannot understand the nuanced risks of your world. You need a specialist who speaks your language. Question 2. Walk me through your process for a new client like me. A master craftsman has a meticulous, proven process. They'll talk about a deep dive discovery call, analyzing your contracts, understanding your growth trajectory, and then strategically approaching the market. A bad broker will say something vague like, "Well, you just fill out this form and we'll get you some quotes." One is a bespoke tailor measuring you for a custom suit. The other is grabbing something off a dusty rack. Question 3. Which insurance carriers do you have strong relationships with? This tells you the quality of the forges they work with. You want to hear names of top-tier, A-rated carriers known for paying claims and being stable. If their list is short or full of obscure names you've never heard of, that's a red flag. It means they don't have access to the best materials. Question 4, and this is a big one. How are you compensated? Transparency is everything. Most independent brokers are paid a commission by the insurance company, which is built into your premium. This is standard, but you need to know what that percentage is. Some may also charge a fee for their service. There's no right or wrong answer, but their willingness to clearly and confidently explain how they make their money is a massive indicator of their integrity. If they get defensive or vague, run. Question 5, the moment of truth. Tell me about a complex claim you helped a client navigate. This is where the rubber meets the road. Anyone can sell you a policy. A great broker proves their worth when things go wrong. You want to hear a story. A story about a data breach where they coordinated the response. A lawsuit where they went to bat with the carrier. A disaster where they were the client's first call and stayed with them until the check was cut. Their answer will tell you if they are a true partner or just a salesperson. And finally, question 6. Can you provide me with 2 or 3 references of clients who are similar to my company? The ultimate proof. A great broker will be proud to connect you with their happy clients. A mediocre one will make excuses. As you have these conversations, keep your senses sharp for the red flags. The signs of a bad blacksmith. They talk more than they listen. They don't ask you probing, difficult questions about your business. They use confusing jargon to sound smart instead of simple language to make you smart. They pressure you to make a quick decision. Or the biggest red flag of all. They lead with price. If the first thing out of their mouth is, "I can save you money," they're not focused on protecting you. They're focused on making a sale. A master craftsman talks about value, about coverage, about protection. The price is a consequence of the right protection, not the starting point. Choosing your broker is choosing your champion, your advocate, the person who will stand beside you when the arrows start to fly. This isn't just a vendor transaction. It's a foundational partnership for the life of your business. Take your time. Do your homework. Interrogate them relentlessly. Because once you've chosen this master craftsman, they will return from the market not with one suit of armor, but with several. A collection of scrolls and parchments from the best forges in the land, each detailing a different proposal, a different price, a different promise of protection. And now you and your chosen advisor have to do the most important work of all. Deciphering the runes, reading the fine print, and choosing the one shield you will carry into battle. This isn't just about comparing numbers on a page. This is about understanding the soul of the contract, the spirit of the protection you're buying. Lay the proposals out side by side. The first thing your eyes will gravitate to is the premium, the price. Ignore it. For now. It's the last thing we'll look at, not the first. Because a cheap shield full of holes is worse than no shield at all. It gives you a false sense of security right before the dragon strikes. Instead, look for the 4 pillars of any policy. The limits, the deductible, the exclusions, and the endorsements. First, the limits of liability. This is the absolute maximum amount the insurance company will pay out for a covered claim. You'll see 2 key numbers here. A per occurrence limit and an aggregate limit. Think of it like this. The per occurrence limit is the max payout for any single punch you take. Let's say it's $1 million. The aggregate limit is the max payout for the entire fight, for the whole year, no matter how many punches you take. Maybe that's $2 million. So if you face 2 separate catastrophic $1 million lawsuits in a year, you're covered. But if a third one hits, you're on your own. This is where you and your advisor must be brutally honest. What is the realistic worst-case scenario for your business? A higher limit means a higher premium, but sleeping at night has its own value. Second, the deductible. This is your skin in the game. It's the amount of money you have to pay out of your own pocket before the insurance company pays a single dime. A higher deductible usually means a lower premium, and it can be tempting to crank that deductible up to save a few bucks. But ask yourself this. If a claim happened tomorrow, could you comfortably write a check for $5,000, $10,000, or $25,000 without crippling your cash flow? The deductible isn't a hypothetical number. It's a real-world test of your business's financial health. Choose a number that's high enough to lower your premium to a comfortable level, but low enough that it won't bankrupt you when you actually need to use the insurance. Third, and this is the most critical part, the exclusions. This is the section written in fine print, hidden in the back, that details everything the policy will not cover. Every policy has them. It's not a sign of a bad policy. It's just the reality of the contract. But this is where nightmares are born. Your policy might cover data breaches, but exclude breaches caused by a rogue employee. It might cover property damage, but exclude damage from a flood. This is where a great broker earns their commission. They need to walk you through these exclusions line by line and translate the legalese into plain English. You need to understand precisely where your shield ends and your exposure begins. If you see an exclusion for a risk that is core to your business, that proposal goes straight into the trash no matter how cheap it is. Fourth, the endorsements, sometimes called riders. These are the modifications to the standard policy. They can be used to add coverage that's normally excluded, or to tweak the terms of the policy. For example, you might add an endorsement for hired and non-owned auto if your employees use their personal cars for work errands, or an endorsement to cover your electronic data. Think of endorsements as custom upgrades for your shield, bolting on extra plates of armor where you need them most. Compare the endorsements on each proposal. Is one carrier offering a critical piece of added protection that another is missing? That alone can be a deciding factor. Only now, after you've compared the limits, the deductibles, the exclusions, and the endorsements, only now do you look at the price. You're no longer comparing apples to oranges. You're making an informed, value-based decision. You might find that the policy that's $200 more expensive offers double the liability limit and includes a critical endorsement the cheaper one lacks. That's not a $200 expense. It's a multi-million-dollar investment. But we're still not done. The paper proposal is only half the story. You also need to vet the company behind the paper. An insurance policy is only as good as the carrier's ability and willingness to pay a claim. So you need to investigate two more things: financial strength and reputation. For financial strength, you'll look at their AM Best rating. Think of it as a credit score for insurance companies. It grades their financial stability and their ability to meet their obligations to policyholders like you. You want to see a carrier with an A rating of some kind, A-A+. A company with a B rating might be cheaper, but there's a higher risk they could go under, leaving you completely exposed, especially if you have a claim that pays out over many years. Your broker should provide these ratings, but you can verify them yourself. Never, ever partner with a financially weak carrier to save a few dollars. It's the definition of penny wise and pound foolish. Then there's reputation. How does this company actually behave when things go wrong? Do they handle claims quickly and fairly? Or do they drag their feet, deny everything, and force their clients to fight for every penny? This is harder to quantify, but it's where your advisor's experience is invaluable. Ask them directly. Have you had clients file claims with this carrier? How did it go? Were they a partner in the recovery or an adversary? You can also look for online reviews, but be mindful that people are more likely to complain than praise. The real intelligence comes from the brokers and lawyers who deal with these companies day in and day out. At this point, you'll have a clear winner. One proposal will rise above the rest, offering the right blend of comprehensive coverage, a strong carrier reputation, and a fair price. Now you tell your broker, this is the one. They will then prepare a formal application for you to sign and submit a request to bind coverage. Binding is the magic word. It's the formal act of putting the policy into effect. Once you've paid your initial premium, you'll receive a binder, a temporary proof of insurance, followed by the full 100-page policy document a few weeks later. Read it, store it somewhere safe, and then for a moment celebrate. You've just built the foundation upon which your entire empire can safely grow. But remember, insurance is not a crock pot. You can't just set it and forget it. Your business is a living, breathing entity. It's going to change. And as it changes, so do your risks. This policy you just bought is a snapshot in time. It's based on your business as it exists today. 1 year from now, you must review it. Have you doubled your revenue? Hired 10 new people? Launched a new product line? Moved into a bigger office? Signed a massive contract with a Fortune 500 company that has its own insurance requirements? Any of these events can fundamentally change your risk profile. Your insurance program needs to evolve with you. Schedule an annual review with your broker. Put it in the calendar like you would a board meeting, because it is that important. This is the process of maintaining your armor, of patching the holes and strengthening the weak points before the next battle. You've done the hard work. You've looked into the abyss of risk and uncertainty, and you haven't flinched. You've transformed insurance from a boring, confusing expense into a powerful strategic asset. It's the silent partner that has your back. It's the safety net that lets you climb higher. It's the bedrock that allows you to build your skyscraper of a dream, knowing it won't crumble at the first tremor. The peace of mind this provides is immeasurable. It frees you from the nagging background anxiety of what if, and allows you to focus all of your energy, all of your passion, all of your genius on what you do best. Innovating, creating, and building something the world has never seen before. Go build it. Go take the big swings. Go change the world. You're ready. You're protected.